Good morning. Welcome to Gilligan Shepherd TV. This morning, we're having a conversation with Richard Ashby, who leads the Gilligan Shepherd tax practice. Good morning, Richard, and happy birthday for yesterday.
Oh, thanks, Michael. Very touched.
So what we want to have a discussion today about, there's been some interesting communications around tax, and just keen to get your view on a number of the developments, the continual developments in the tax landscape, and what this means for our clients and for business in general.
Right.
I noted this morning in one of your messages to the team, the urgent bill the government's just passed through the House this week. I noticed the discussion around the new loss carryback rules. Can you explain what these mean to me in, say, layman's terms, and the implication to business?
Sure. So I guess in simple terms, this is it's basically at the moment it's a temporary measure, and it is going to cover a period of 2 income years, the 2020 and 2021 income years, with respect to any losses made in those 2 periods. Mm-hmm. And in essence, what the rules will allow you to do is, if you've made a profit in either the 2019 or 2020 income years, then you'll be able to carry back as appropriate to the previous year, either your 2020 profit, 2020 loss back to the 2019 profit, or the 2021 loss to a 2020 year profit. Mm-hmm. And basically the rationale for doing that is that loss will, of course, result in a tax refund of either previous taxes you have paid in respect to the 2019 year, which most tax returns would have been filed by now, mm-hmm. Or a potential reduction in your 7th of May provisional tax payment for the 2020 tax year that's coming due.
Great.
We may either have a reduced tax payment now due, or a refund of provisional tax already paid in respect to the 2020 year.
Wow. Okay. Really helpful.
Yeah, and you know, so some of the things I guess around it to understand, as the carryback will be available to basically most taxpayers, whether you're a company, a trust, limited partnership, individual. There will, however, be an exposure to use money interest if you overestimate your loss that you are expecting to derive. Mm-hmm. The rules basically do not require you to rush and try and re-estimate or estimate your 2020 income year loss to be able to reduce your 7th of May payment. Usually your estimation for provisional tax for your final instalment would be due to be made on the 7th of May. But under these new rules, they're extending the date where you can make a re-estimate basically to the earlier of when you either file your 2020 income tax return, mm-hmm. or when that tax return is due, which for most people with a tax agent will be the 31st of March next year. So plenty of time to basically consider what potential losses you may make for the 2021 income year in order to use this carryback rule to the 2020 year.
Wow, so some real practical benefit, cash benefit to a business.
Yeah, correct. And it also can extend to the shareholders in respect of particularly the 2020 year. So if shareholders have paid provisional tax already, yes, on the expectation that they will get a shareholder salary for the 2020 year, but due to perhaps an expectation now they'll make a loss in the 2021 year, mm-hmm. Which will now offset the taxable profit in the 2020 year, they may no longer receive that shareholder salary. So they'll also be able to basically re-estimate their provisional tax payments for the 2020 year, that final instalment, and get a refund of provisional tax already overpaid. A couple of important things to understand is the normal shareholder continuity rules apply, whether it's a 49% rule because you've got a loss carry forward from one year to the next within a single company,
Mm-hmm.
or your grouping rules, because this loss carry back rule will also apply to companies within a corporate group. Usually requires a 66% common ownership,
Mm-hmm.
whereby essentially the loss company, to the extent that it's offset any other group company's profits in the 2021 year, will be able to carry that loss back to the 2020 year where there's an excess of loss. Normal imputation credit rules apply. So
Yes.
if you are going to be doing a carryback and it's going to result in a tax refund, of course you have to have sufficient imputation credits available before that refund will be paid out. This could have an impact, I guess, for companies that have already prepared and filed their 2019 income year accounts, and with the profits, of course, they've subsequently declared a dividend to the shareholders, which has stripped out the imputation accounts.
Right.
Under these rules, of course, they may find that while they can certainly still use the loss carryback and potentially create a tax refund for the overpaid taxes in the 2019 income year, if they don't have sufficient imputation credits available, then that refund is just going to sit there to be offset against future taxes payable by the company.
Okay. So I guess it's one of those usual situations where the devil is in the detail, and it certainly doesn't sound like this is a DIY job.
Yeah, that's right. Yeah.
But one of the things I also noticed, following on from that, and that was really, really clear, that was just one component of what seemed to be quite a broader tax proposal announced by the government over the last couple of weeks, or about 2 or 3 weeks ago. What else is on that immediate horizon in terms of the tax-related changes that the government is announcing or implementing as we speak?
Yeah, so there was another what we call the second round of announcements by the government in respect of their COVID-19 sort of tax-related packages, came out a couple of weeks ago.
Yeah.
And you may recall this, at the start there I said, this is a temporary loss carryback rule.
Yes.
There is, however, a proposal for a tax bill to be introduced towards the middle of this year, or the latter half of this year, to make that a more permanent regime, applying from the 2022 income year and going forward. They may also consider, when they do that, of extending the ability to carry back to 2 years rather than the present 1 year rule under the temporary regime. The other thing they addressed was the government's aware, of course, with business cash flow affected by COVID-19, particularly going forward. There's going to be a lot of companies out there, particularly that may be looking for new investment capital. Presently, yes, we have some loss continuity rules. Basically requires a 49% shareholder continuity be maintained from the commencement of the income year in which the loss was incurred until the end of the year where it's offset. Naturally, if you bring in new investors, this could breach your continuity, and suddenly you've lost your loss. So not only are you negatively impacted by your cash flow from COVID-19, but you've suddenly lost your tax losses as well, simply because you just needed to get much needed cash into the business through new investors. So one of the other proposals is also to look at perhaps bringing in a similar regime to Australia, where they have like a same or similar business test, that provided you can show that effectively post the shareholding change, which would otherwise breach your 49% continuity, the business is sort of same or similar, then you won't have a loss forfeiture as a result of that shareholder change. Now that's also proposed to be legislated for in a tax bill later this year.
Well, that seems like a really pragmatic approach to it, right?
Yeah, and there has been some talk. I mean, arguably that's the revenue or the government was going to consider these rules anyway, and I guess COVID-19 has just really encouraged them to bring that thinking forward. The only other thing of a tax-related nature is that's will also be passed in the present bill. That's just awaiting royal assent now. Is just a more flexibility around the revenue to be able to change affected taxpayers' due dates or other compliance obligations under the Income Tax Act. There is presently the ability of the Commissioner to do that anyway in current legislation, but certainly for a wide group of affected taxpayers, normally that has to be achieved by passing what they call an order in council, which of course is a timely exercise. So these changes going through now will just basically give the revenue the ability to be more flexible and more expediently as well to obviously address concerns taxpayers have in respect of complying with their tax obligations.
Yeah, well, that also sounds like a positive move, because certainly flexibility, no disrespect to the revenue, is not something that you would naturally associate with them. And sort of related to that, obviously, COVID-19 is, and the response to that has been, has been interesting. It has actually looked to be quite quick, and there seems to be a range of things in there. Earlier this week, you posted about a special report released by the Revenue on what they've done and what they've called their first round of tax-related changes. Is there any sort of recap that you can share with us, just from your perspective, about how do you think that's gone and what are the practical implications of this sort of first round?
Yeah, so there was a number of things in that first package that were again sort of aimed at providing perhaps increased deductions to taxpayers or accommodating them for the inability to make payments on time due to cash flow issues associated with COVID-19. A couple of those they've reintroduced depreciation deductions for commercial buildings from the commencement of the 2021 income year. So those rules basically in effect now.
Right.
Where you'll be able to claim a deduction on your commercial building going forward. They've also increased the provisional tax threshold for the 2021 tax year to $5,000 residual income tax.
Okay.
This is effectively the threshold that determines whether or not you should be a provisional taxpayer. Presently, it's $2,500. So once your tax payable for the year effectively exceeded $2,500, you had to start paying provisional tax. For the 2021 year going forward, that's increased to $5,000. So the immediate statement from the government suggested, of course, it's immediately going to take a certain number of taxpayers out of the provisional tax net, thereby providing them with additional cash to support their businesses. There's an increase in the low value asset. I mean, it's quite a minor change, but it's presently if you brought what you call an asset, say a laptop, I guess, and the cost was more than $500, then you had to depreciate that asset. You couldn't get an immediate write-off for it. Effective 17th of March 2020, that small value asset write-off has increased from $500 to $5,000, where it will remain for the next 12 months to the 17th of March 2021, and then it will reduce to $1,000 permanently going forward. And a couple other things was, I guess, and we've seen, I guess, in action already is the flexibility now for the post 14th of February 2020. Any taxes payable that the taxpayer has been unable to pay on time due to the effects of COVID-19. In the past, of course, they would have been immediately subject to use money interest charges.
Right.
Now, basically, as long as they contact the Revenue as reasonably as practical post or even prior to that tax's due date, make an arrangement with the Commissioner, basically of when they expect they'll be able to pay that core tax. Then provided they stick with that arrangement, then at the end of that arrangement, the use of money interest charges will be automatically remitted.
Wow.
And I guess the important thing to understand here is that for those taxpayers entering into an arrangement, you will still see an accumulation of penalties and use of money interest on your assessment. But provided you stick to your arrangement, and that can be renegotiated during the period as well, if things don't turn out as you expected, then you'll be able to basically those penalties and use of money interest will be automatically remitted. You won't have to do anything else at the end of the term.
What's a reasonable period to renegotiate that for? Is it 3 months? Is it 6 months? Could you say?
Well, look, there's two things we've noted here with these proposals, because it's one thing to have it written down in the legislation. I guess it's another thing to see how the revenue applies it in practice.
Right.
But we've had cases where we have had clients contact us, and we've contacted the revenue via a direct message through the MyIR system. And within 10 minutes, the revenue's come back and agreed to the arrangement, and it's all been put in place. Usually what we've noted is if it's within 6 months, say no later than September presently, then the revenue seems to be pretty accommodating. Goes any further than September, takes a bit longer to get a response, but not unreasonable. I guess the revenue might just ask you for some additional documentation to say, well, why do you need that long? So you might have to provide some more stuff. But very responsive they have been. So.
Oh, I'll take back what I said earlier. So it is a deferral. It's not being, you're not removing your obligation, but okay, that's helpful.
You're still paying the core tax, but then, and that's a good point actually, because alongside that, of course, they are also restating, look, remission of use of money interest is just one thing that may be on offer for you. We always have our, financial hardship provisions where you can get a write-off of tax, installment arrangements of up to 2-3 years, which can be achieved as well. So just because I guess that just remember about what else is out there as well. What else could be available?
Okay, really interesting. Finally, one of the more popular or increasingly popular topics has been around the wage subsidy. Now, I've heard of clients who've claimed the subsidy, and boy, that process went real quick. Now feel that their business may actually have performed better than they first expected, right? Between now and say June this year. So they're unlikely, and good for them, to have experienced that the 30% reduction in revenue. It might only be 20% or 10%. I mean, it's still a reduction, but it's not going to be that threshold that was put in place. Yeah. What's your sense? I mean, is this something that they have to now consider paying back? Is this something they should offer? Do they need to wait? What's your take on that, Richard?
Sure. Basically, if if you get into a situation, I actually had a client ring me the other day. They'd applied for a subsidy, and actually it's probably the quickest I've heard of. Within 4 hours, they were paid nearly $50,000 into their bank account from the subsidy. They've just realised that their business is not going to be impacted as much as they thought. Therefore, they're not going to experience the 30% requisite decline in revenue. So they were basically just asking me, well, how do we pay it back? And certainly the work and income website facilitates that. I can just give you the address just in case. workandincome.gov.nz /COVID-19 /wage-subsidy /obligations will get you to the page. But in essence, while the government's basically taken an approach of honesty first, we will basically just accept any application at face value. Right. Sure, they do some matching checks just to make sure that the application ties up with what the IRD has on its records. But in most cases, there's no questions asked. They're just basically approving the applications. Along the way, of course, they've always said, however, once this is over, or we get through this, we're going to come back and audit, just to make sure that taxpayers were entitled to make the claims they did. And therefore, there is really an onus on a taxpayer to make a repayment where they feel that they shouldn't receive the subsidy in the first place.
Mm-hmm.
And that could be for a number of reasons. One, they've now received an insurance payout for some sort of business continuity insurance. That takes them out of being eligible for the subsidy. They may, of course, find that they no longer need it because they haven't received or experienced the revenue decline they thought they were going to.
Mm-hmm.
Or they may have actually just breached their obligations, because the whole point of one of the things you had to do when you applied for the subsidy was commit to retaining your employees for the full 12-week period
Right.
through to June. So
Mm-hmm.
for those that have laid off employees now, I guess you have an exposure to paying the subsidy back because you've no longer met your commitment.
Right.
Now, that's not to say if you've had a voluntary leaving where the employee has come to you
Mm-hmm.
and said, look, I'm out, I'm going to go and do something else, or for whatever reason, that's not you breaching your commitment. Okay, so in that situation, you don't have to pay back the subsidy.
Right.
And there is information on the work, and that's one of on that work and income site, there is a list of frequently asked questions, and that is one of the questions covered. So
Excellent. Look, thank you for explaining that. One final question, if I can. One of the other topics of conversation that we are hearing about what the new business as usual is going to look like. Some of the conversations have been around, with all of the massive government borrowing and the impact on our economic settings for our economy. The spectre of tax increases, both a GST and a personal increase to the top tax rate. What's your sense on that? And what are obviously going to be some of those unintended consequences if in your opinion, that is something that does become a reality?
Yeah, well, I've heard some of those comments too. I guess my first reaction is, well, I guess you could say that whether it's a bit of sarcasm jumping in here, but it's an election year. Are we really going to see a government who's vying for another term suddenly bring in an increase in the top personal tax rate, or particularly, and definitely one that would hit more people in the pocket, of course, would be an increase in the GST. So I just, there's no change to the election date. It's still September at this stage. So I wouldn't expect to see anything on the table before then. I think the first real indication we'll get of this, of course, will be budget night, or budget day now, as we used to call it budget night, but which is only in a couple of weeks. So I'd say just watch this space. But they're certainly going to have to fund it somehow. But whether it's just a case of saying, well, as an economy, we're just going to be in a debt for a while. We had a good balance sheet, arguably, before we went in. So, it's not like we were in the negative and we went further negative. So we might just have to see if we can wade through this without doing anything in terms of tax increases.
Cool. Thank you for that reassuring the world, as always. Appreciate your time. For any questions, if anyone would like any specific answers or any questions addressed, if they can email marketing@gilshep.co.nz. That's marketing@gilshep.co.nz. That should be on the screen now. Other than that, Richard, have a fantastic day or an epic day, and look forward to talking to you soon.
Thank you, Michael. All right.